Had a lot of really good comments and questions from our prior videos, and one of the economic theories that comes up quite a bit has to do with when there's a recession, won't that bring prices down? We have a series of inflationary events over the last 12 to 18 months where prices of everything have gone up. Gasoline, insurance, real estate, rents, groceries have all gone up. And consumers and businesses are looking for that event that's going to trigger a reduction in those prices. And what comes up a lot as well, if we go into a recession and there's less demand, supply and demand, won't that lower the prices? Won't lower volume also reduce prices? Won't businesses want to get more business and be more competitive? The cars that you see on the dealership lots that have skyrocketed in price and adding on additional fees, won't that stop when there's lower demand and lower prices? When people stop having excess money to spend, won't that lower the prices? And the answer is no. In theory, the prices should come down when demand goes down and people don't have money. But in this particular perfect storm of events, the prices are not going to go down. Now, inflation might go down. The rate of inflation may reduce. But don't confuse inflation with prices. And let me explain. When the inflation rate is, let's say, 10%, that means that every year prices go up 10% versus the price of the prior year. That's the rate of increase. If inflation goes to zero, that means that the price stays the same as last year. So even if the inflation rate goes to zero, that means that the prices are going to stay what they are now. They're locked in. They're not going to go down. Why is that important? Well, let's suppose you're talking about construction of a home or a remodel or an addition. You might think that with lumber prices having gone up and inflation on labor costs and fixed costs, well, when demand goes down because interest rates are higher, people don't have as much money to spend on remodels or buying a new home, or the interest rate that they would have to pay for a mortgage makes it more expensive, and fewer people will do a remodel or buy a new home. That may be the case, and that probably will happen. In fact, it's already happening. But why won't that lower the prices? Well, a few reasons. First is the cost to the developer, to the builder, of doing a construction project is actually going to go up. If volume goes down, prices go up. You've heard of high volume, low prices, right? Remember the old car dealership advertisements. Hey, we sell in volume so we can afford the lower price, right? Think about the higher volume retailers of anything. If you go to Walmart where they sell a ton of, deck furniture, the price is going to be lower than if you go to a boutique custom, home store that doesn't sell as much. Their price is going to be higher. The same thing will happen in the construction industry and is happening. When there's lower volume, the cost is going to go up. And make sure you keep an eye on our channel. We're going to produce a video in the next week or two that will give you a calculator on how to figure construction cost of a new home or a remodel. But here's what goes into those costs, which is going to go up. Fixed expenses. So every builder, contractor, construction company, even a small subcontractor like an electrical contractor or a plumbing contractor, has a certain number of fixed expenses. The rent on their building. Maybe it's something they own. They have insurance. You have taxes. You have utilities. Even if those stay the same, first of all, they're going to go up, but let's just say they stay the same. You have licenses. You have the income and salaries of your staff that you pay no matter what. If you have jobs or not, you pay those salaries. You also have catch-up expenses from 2019 to 21 when you couldn't do as much work. So you take all those fixed expenses, even if you don't do one project, the builder has to pay those expenses. So now, if you go from doing, let's say, 20 projects a year, and you divide up all those expenses, let's say, for example, all those expenses are $1 million a year, right? Roughly $80,000 a month, let's say, altogether. And you divide that by 20 projects. Well, that's $50,000 per project that has to go to your fixed expenses. And that's a normal thing that you add in. But let's say now you have only 10 projects a year as a builder. You still have your same $1 million fixed expenses. Your salaries, your mortgage, your rent, your taxes, your licenses, your bonds, your insurance. All of that now has to be divided over 10 projects. So now you have to figure $100,000 per project to cover your fixed. In addition to all your other variable costs, your lumber, your additional services, maybe you have to add some labor. I'm talking about your fixed expenses. So if there is lower volume, producers of products, whether it's home builders or materials contractors, a small mom and pop retail shop, a restaurant, even large manufacturing companies, they have their fixed expenses divided up over their product sales. And if you have fewer sales in terms of volume, fewer sales in terms of the customer demand, you now have to raise prices to meet your fixed expenses. Certainly some of those fixed expenses you can reduce over time. If you see that after a year or two, your volume is chronically lower, yeah, you can start eroding some of those fixed expenses. Maybe you can move to a smaller building. Maybe you can reduce some staff. Maybe you can have less insurance. But you can't turn on a dime and do that instantly, because if you do, you may not be able to meet the needs of even your 10 projects you have, right? In fact, some of them you can't reduce at all. You need, whether you do 10 or 20 projects, you still need the same amount of basic support and basic admin in logistics. So lower volume of sales isn't going to automatically take the law of supply and demand and make prices go down, especially for building contractors, because those fixed expenses still need to be accounted for. Now, if you are smart and you're a contractor, general contractor, builder, you can use some efficiencies to be very competitive without sacrificing quality. You can use some automation. You can use economy of scale. You can use some other KPI strategies to manage your projects. You don't necessarily have to go up in price. You just have to be more efficient with your projects. Maybe getting rid of waste. Maybe spending more time. Look, if you have the same number of staff working on 10 projects versus 20, that staff can now spend that extra time to be more precise and concise with materials purchasing, labor allocation, subcontractor bidding, maybe even timing of projects so that there's less overlap or less gap in between. Maybe it's a time to look at ways to reduce some of the construction costs. A lot of times, out of convenience, as a general contractor, you're going to have some expenses that just make your life easier. You might rent an excavator for 2 months to get a little bit lower rate, even though it's going to be downtime for half that period of time. Maybe instead you rent on an intermittent basis, or work with a competitor even to rent something and share that cost over the course of 2 months. Maybe you work with some subcontractors to provide some of their labor or some of their work product. Now that you have the extra time, don't look at it as dead time and expense. Look at it as a way to improve your business. Maybe the sales department now has more time to work on projects that have more net margin. Even the licensing manual for most states, when you get your contractor's license, tells you very specifically, be sure to include your fixed expenses in your costing of jobs. And the reason they tell you that is not to be greedy and not to have contractors ripping off customers. It's because the biggest problem that consumers have and licensing divisions have with contractors is contractors that go out of business. Contractors that take jobs, they start them, and they don't complete them. And the reason why is because contractors sometimes, if they're not careful, will not manage their finances properly. They won't have proper capital reserves. And it's because they leave out their fixed expense. They say, well, if this job is going to cost me $50,000 in materials and $50,000 in labor, my cost is $100,000. I'll sell it for $130,000. What they didn't, and make a little bit of profit, what they didn't calculate was their fixed expense that they have to pay. All the rent, electricity, heat, water, insurance, bonds, their administrative costs. And so now their cost is really $140,000. So when they do it for $130,000, they're actually losing money. So in the licensing manuals of almost every state, it tells you very specifically, be sure to include your fixed expense. Not only will those fixed expenses not going to go away, they're probably going to go up. As real estate has a higher value, the appraisers for the counties and the tax assessors are going to start jacking up the tax rates. So whether you own your property as a builder or you rent it from a landlord, commercial property, your rent's going to go up. If you're on a triple net lease, your tax component is going to be higher. As inflation starts to affect insurance claims, your insurance is going to go up. Your bond fees are going to go up. I'm sure you've already had to raise pay on many employees, even your admin employees, your office employees. All that's going to go up. So whatever cost basis you've included in your bidding for fixed expenses, you're probably going to have to make an adjustment for that. Not only in terms of absolute dollars, but contributory dollars on the number and volume of projects you work on. Look, this interest rate climate is going to result in fewer remodel, additions projects, because most of the money that goes into a remodel or putting an addition on a house comes from a home equity loan or second mortgage, right? People have a house, they live in it for 4 or 5 years, they build up some equity, they realize that, gee, my mortgage is $250 and now it's worth $500. Let's take out $150,000 and put that addition on. Let's take out $50,000 and redo the kitchen. Well, that's easy to do when interest rates are 2 or 3%. When interest rates are 6%, fewer people will do that. Sure, certainly still some people will take out some equity and some people will have cash. But the volume is going to decrease. And when it does, that's going to put pressure on builders. Now, some of them will actually exit the business. We've already seen that. Some of them will keep bidding projects the way they did and eventually be forced out of business financially. Very few are going to actually reduce prices because you can't. You have your fixed expenses you have to pay. In fact, there's probably a deficit of income because from 2019 to 2020, between lockdowns and pandemic and permitting problems, there were fewer projects that get through the pipeline. So many builders are now having to replenish their capital reserves, and that's going to come from newer projects. So as an observer of the economy, observer of the building industry, or if you're a potential client looking at a remodel project, or if you're a builder, it's very unlikely that this lower volume of projects environment is going to result in lower or significantly lower prices because of economic math. It's not that the builder is trying to rip you off in most cases. Obviously, there's some builders that are dishonorable. But like I said, we'll give you a little worksheet here in the next week or so of how to calculate some cost on an addition or remodel, or even a new construction for that matter. It's just economic facts, in the same way that there will also be some pressures and stress on municipal budgets. The governmental agencies that run your city, state, county are going to have problems because they will also have a lower volume of revenue and income from sales tax, from payroll taxes. And that's going to affect their budgets, and they're going to have inflation at the same time. This is all going to be a big squeeze. It's the worst case scenario, perfect storm of inflation and recession at the same time. They used to call it stagflation back in the 70s. But that combination of inflation and recession is going to be a tricky navigational economic milestone. A smart business operator can actually use it to your advantage. We'll talk more about that in future videos. But the answer for this particular episode is the lower volume is not going to necessarily result in lower prices because of those fixed expenses. Even if the fixed expenses don't go up, they're going to be divided up over fewer projects. Keep those questions coming. Love doing these videos. We'll see you next time.